This is the Daily Market Comment by Marios Hadjikyriacos and Maria Pachouridis. Thanks for joining us at XM.com. The pendulum in global markets continues to swing back and forth between inflation and growth concerns. Any good news on the economy stokes fears about rampant inflation, while any bad news adds credence to recession risks, but the US dollar ends up victorious in both cases, either through bets for faster Fed rate increases or via safe haven flows into the reserve currency. All news has essentially been good news for the greenback, which has left a trail of destruction in the FX field. The euro has been steamrolled by the energy crisis that has deprived it of its historical trade surpluses. The yen has been crushed by monetary policy divergence, while sterling and the commodity-sensitive currencies have been prisoners of shaky risk sentiment. A surprisingly strong U.S. jobs report dispelled some worries around growth on Friday. Employment data is a lagging measure of economic activity, but even so, the fact that the labor market is still humming along added the final touches to market pricing for another triple-barreled Fed rate increase this month. Over in Japan, the nation's ruling party scored a decisive victory in the elections for the upper house of parliament over the weekend. Dollar-yen poked its nose above the 137 region for the first time in 24 years. In the aftermath, as the results suggested, the balance of powers would remain unchanged, allowing the Bank of Japan the freedom to keep yields pinned on the floor. Three elements can turn the tide in the yen. Domestic inflation fires up and the BOJ pivots. Global recession risks dominate and foreign yields decline alongside energy prices, or the depreciation becomes unbearable politically and provokes FX intervention to flush out speculators. One way or another, there is some light at the end of the tunnel in this terrifying downtrend. In the equity market, Wall Street futures are flashing red on Monday, with market participants nervous ahead of what promises to be a stormy earnings season that will get rolling with big banks this week. Earnings growth for the entire S&P 500 is projected at around 5 to 6% on a yearly basis, which seems like an easy target to overcome in an environment where inflation is running much higher. The real question is whether business executives will strike a cautious tone and lower earnings guidance for the rest of the year, and most importantly, how much of this downgrade has already been priced into battered share prices. This is the Daily Market Comment. Thanks for joining us at XM.com.